Down markets aren't just setbacks, they're opportunities. And in this episode of Retire Stronger, we reveal smart, proven tax strategies you can deploy in bear markets to reduce your lifetime tax bill and position your portfolio for recovery. Welcome back to Retire Stronger, episode 26, the show where we help you retire smarter with more confidence and with strategies that put you in control of your financial future. I'm John Foard.
And I'm Bill Kearney. And today we're talking about a topic that can feel a little uncomfortable, but also incredibly powerful. What to do in a down market. We're going to focus on the silver linings, the tax moves that not only work during bear years, but can set you up for significant long-term gains.
That's right, Bill. Markets go through cycles, and they always have, and they always will. But most people see a downturn and they think loss. What we want you to see is opportunity. Because in the right context, bear markets can actually hand you a window to make strategic tax moves that might save you tens or even hundreds of thousands of dollars over your lifetime.
That's exactly right. And the reality is you can't time the market. If you try to time the market, we always say you have to be right twice. You have to be right getting
Correct.
out and you have to be right getting back in. It's really, really difficult to do that and be successful. But you can control your tax strategy. And so when values are down in the market, your tax planning tools need to get more powerful. So today we're going to cover the most effective strategies we use with clients during bear markets. Here it is, Roth conversions. But Roth conversions at discounted values, tax loss harvesting, rebalancing opportunities, charitable gifting strategies, and a few advanced moves like asset location shifts and estate planning tactics. And of course, I say it in jest here with the Roth conversions. We talk about it all the time. It's a huge part of what we do, and it's a huge part of tax planning. But before we jump into all of that, let's talk about the mindset shift in a bear market, right? And we call it basically the emotional side. And I'm going to put up on the screen essentially the kind of the flow that happens with investors, right? The emotional flow that happens from all the way on the left side with optimism to all the way down the bottom of capitulation, right? And panic down there. So, and if you're like most people, a bear market feels like a giant red flashing warning sign. The news is negative. Account balances are lower. You're feeling anxiety. The instinct here is to retreat, to sell, to stop investing. I'm never going to make this mistake again. Wait things out, move to cash. There's all sorts of things going through your mind. But that mindset often it works against you. All right. Instead of letting the emotions of what's happening with the market overtake you, we encourage a proactive view. Lower valuations mean that you can reposition assets with less tax consequence. Think about a Roth conversion. When your account is down 20%, you're moving more shares into your tax-free bucket for the same tax bill as you would have paid on fewer shares in an up market. So then when the market recovers, the growth happens in that tax-free environment.
Yeah, Bill, it's so true. And I always remind my clients, your wealth is not the number you see on your statement today. It's your long-term purchasing power and how much of it you get to keep after taxes. I mean, if we can make moves during down years to reduce lifetime taxes, we're essentially buying growth at a discount. You're buying it on sale. That shift in thinking from fear to strategy is basically what separates people who come out of bear markets stronger from those who simply ride the wave and just hope for the best, right? So I know we've already mentioned it once. I'm going to mention it again. Let's talk about Roth conversions in bear years. One of our favorite moves, quite frankly, in a down market is the Roth conversion, largely, I should say, based on what we just talked about. And we've talked about this before in the context of required minimum distributions and tax brackets. But here's why bear market years make it even better. Let's just say, for example, you have a you have $200,000 in a traditional IRA, and the market drops 25%, quite a significant drop, quite a significant bear market. Now that brings the value down to $150,000 in value. If you convert $50,000 of that to a Roth IRA now, you're paying tax on those shares at their depressed value. And when the market recovers all of that growth, which it eventually will, back to the $200,000 value and beyond, that happens inside the Roth completely tax free, assuming you play by the rules of the IRS, right?
Yeah, and let's not forget that the benefit compounds if you're in a relatively low income year. So maybe you've recently retired, but you're not yet collecting Social Security, or you've intentionally reduced earned income. Um, in this instance, bear years often coincide with temporary lower tax rates for certain households, anyhow. So you can get a double win: lower asset values and lower marginal tax rates.
Yeah, and we always stress, folks, this isn't about beating the market. It's about controlling what you can. And with Roth conversions, you can control both the timing and the tax rate if you play your cards correctly. So in bear years, those factors very well may be in your favor, right? And so
Exactly
no, I
right,
know you
John.
wanted to talk about tax loss harvesting, Bill. So
I did. I kind of feel like you should, since your name is John, which is close to John Deere, and John Deere would be harvesting things, right? How about that for a horrendously bad joke, right? So, even though John is the one who loves the harvesting part of things, we're going to talk
uh,
seriously about tax loss harvesting. This is where you sell investments that are down to realize a capital loss. Why would we ever want to do that? Well, if we realize a capital loss, we can use that to offset a capital gain, or up to $3,000 of ordinary income each year. So in a bear market, you have more opportunities to realize these losses. This is the tax loss harvesting part. But the key is to stay invested. We don't want to sell and go to cash. We want to sell and then immediately buy something similar, but not substantially identical, to avoid the wash sale rule uh,
y-
in all
yeah,
that.
yeah, that's right. And we see that problem happen, pretty regularly. It's hard to avoid sometimes.
Can
But if
you
you own, for
explain, John?
example,
Could you explain? I'm sorry. Could you
yeah,
explain
no,
the
no, no.
wash
I was
sale
going to
rule?
say, if you own an S&P 500 index fund that's down, you might sell it and buy a different large cap index fund, keeping market exposure, but locking in the loss for tax purposes, right? And over time, those losses become a bank you can use to offset gains in future years, especially useful um, if you sell appreciated assets down the road. And I think you were about to ask me to, or I think I heard you ask me to kind of explain what the wash sale rule is. Is that what you were about to ask me?
Yeah, exactly. I didn't want to gloss over that.
Yeah, no. So the wash sale rule, for some folks, it can be difficult to wrap their mind around it. Why, um, if they sell, say, for example, I don't know, Apple stock for a certain price, and then turn around and buy a another stock that would be considered identical in the type of stock or type of company that Apple is, they could trigger the wash sale rule. So it's not necessarily selling Apple today and then repurchasing it tomorrow or within a 30 or 60-day time frame. It can also be other stocks that are similar to Apple, or if you buy if you're owning Vanguard's S&P 500 index ETF and you sell it, and then 5 days later you buy Fidelity's S&P 500 index ETF. Again, the IRS looks at that as an identical investment, and you're going to trigger the wash sale rule because it's a 60-day window that you have. I believe, if my memory serves me correctly, we'll have to double check that, but I believe it's a 60-day window of time between selling and buying quote unquote materially identical investments that can trigger that wash sale rule. And if you do that, if you trigger that rule, then you negate the tax loss that you could potentially have. Um, on that transaction. So I hope I explained that in a way that made sense for everyone. If you have questions, always reach out. We're happy to go through it with you.
No, it's great. Very well explained. And I think it's just important to note that's a small little caveat that could throw a wrench into what you're trying to do here. But I wanted to share this emotions of investing piece one more time, because what we're talking about here is a strategy that essentially feels counterintuitive at first. So we're on the part of uh, this rise and fall here where we're in anxiety, denial, fear, depression, panic, right? These types of fears, these types of emotions are paralyzing for a lot of people.
Hmm.
Um, One that's not really in here is probably anger. People get angry when these things happen with the market, and they're caught inside of them. So
Hmm.
we're talking about doing something that is extremely counterintuitive, and that's first of all stopping, taking the airplane back up to 10,000 feet and surveying the landscape and changing your approach on what you would normally do here, selling in a
Hmm.
down market. But look, when this is executed correctly, it's purely about tax efficiency and it doesn't change your investment allocation. So we're really trying to make lemonade out of lemons here, right? We're going to have situations. If you've been invested for any length of time in the market, you know you're going to have fluctuations. You know there's going to be volatility in the market. The key is, what options do you have to deal with it at that point in time, and what options will set you up for the next 5 to 10 years at being a successful investor. And learning how to read and control your emotions is a huge part of that.
Yeah, well, I think it would make sense to further the conversation that that you were kind of alluding to and leading into by resharing that investor emotion graph. Is that we have you know it kind of alludes to rebalancing and the asset location, the opportunities that you have within those two areas of managing your portfolio. We talked about tax loss harvesting, and selling something at a loss to offset gains. But bear markets can throw your allocations really out of whack. Um, you know, but if you own bonds, they could have held steady, and if you own stocks, they could have dropped, or vice versa. And suddenly, you know, if you have, we could talk about this on a whole nother episode, and we're not going to get into it, but let's just use it for example's sake. If you have a 60-40 portfolio, it could be now a 70-30 portfolio, or maybe even a 50-50 portfolio. And that's a great time. It's a natural time to do a rebalance of your portfolio, which often means buying the asset class that is down or depressed in value, that has come down with the market, with the bear market, right? And so, I don't know. Anything you want to add to that, Bill?
Yeah, well, I mean, this is where you can add in a little bit of a tax twist here, right?
Right.
Think of it this way: you're not going to, not all accounts are going to be treated the same way from a tax standpoint, and the actions and steps you take. So if you're rebalancing in a taxable account, you can often pair the buys and sells with tax loss harvesting, which
Hmm.
helps reduce your tax costs for those accounts. If you're rebalancing in IRAs, you can shift certain asset classes into Roth accounts during conversions to maximize future tax-free growth. So there's a little bit of a strategy inside of the types of accounts you have to help with the tax problem in here as well, all inside of the bear market analysis that we're doing.
Yeah, I mean, it's just, again, using Roth conversions to help rebalance your portfolio basically by shifting from your traditional IRA or 401k to a Roth, and helping rebalance those accounts into proper allocations. Um, and we also look at, I mentioned asset location, right? And so down markets, bear markets, an opportunity to move high growth potential assets into a tax advantaged account. So just what we were talking about by doing potential Roth conversions again, and then also moving lower growth or income oriented assets into taxable or pre-tax accounts. Over years of time, this positioning can have a huge compounding effect on after tax returns. Anything you want to add there?
No, I think you've have said that well. I think the next one that we wanted to talk about was charitable giving strategies, and ways that you can use giving to charity in situations like this. So for our charitably inclined clients, bear market years are perfect times for certain giving strategies, and maybe to analyze what you're doing from a giving strategy standpoint. So donor advised funds, for example, let you contribute shares that might be down in value now, but what you expect to recover. So you get the deduction today and the charity benefits from the future growth of that asset that has declined.
Oh yeah, and even if you have appreciated assets from before the downturn, gifting those avoids the capital gains tax entirely. While still getting a full deduction for the fair market value. And for retirees that are taking, taking the required minimum distributions, a qualified charitable distribution from an IRA can satisfy that RMD in future tax years. Um, eh, uh, Bare years can be the planning window to set that up, is what I guess is what we're alluding to. And I know we mentioned that in a previous episode, but I just thought it'd be worth re-hitting that real quickly here as we discuss
Exactly.
this today. Yeah, so I know we also wanted to talk about estate planning in a down market as well, Bill. And let's not overlook estate planning moves that you can make if you're considering gifting assets to heirs. Doing so when values are lower means you can transfer more shares under the annual gift tax exclusion. Again, when the shares are lower, you're able to transfer more of those shares. Again, this also requires, or not required, but what we're discussing here is not liquidating these shares to cash and then giving the money away. We're talking about actually transferring shares in kind to an heir, or to someone, or whatever, and then allows them, those shares to come back in value when the market rebounds. And all that growth happens outside of your taxable estate, thus helping you with your estate planning goals that you might have, right?
Yeah, exactly. And there's even some more advanced tools. We don't utilize these as much, but they're available. There's lots of little tools like this, like the grant or retained annuity trust, or
Hmm.
as John likes to refer to them, grats. Uh, the family limited partnerships. These bare years often improve the math and make the strategies more effective. It's a window that wealthy families shouldn't ignore. You're definitely going to want to work with a qualified financial planner who works with these types of strategies, and also an estate planner, a combination of those two to figure out which of these work well for you, and which of them don't.
Yeah, I mean, folks, at the end of the day, we know that down markets can feel painful, right? But hopefully, you see now, after the discussion we're having today, that this can also open doors and provide opportunities between Roth conversions, tax loss harvesting, rebalancing, charitable giving, estate planning options that can help you. Um, these aren't just damage control strategies; they're long-term tax plays that can permanently improve your financial position. And so we just want to really make sure we hammer that home, that this, you have opportunities here. It's not everything's not a total loss if we have a bear market.
Exactly. And, I feel like we went through all of that really quickly. So I would advise the listener, look, if you're not sure, um, this is a great opportunity to reach out either to your financial advisor. If you don't have one or not sure who to talk to, you can certainly reach out to us. Our website is crownadvisorgroup.com. We'd love to schedule a call with you to figure out these types of situations. And by the way, you don't have to wait for a bear market to ask these questions. These are the sort of things that are maybe advanced planning that you can work on to say, well, when we do have another bear market, what are some of the things that would work well inside of my portfolio? And John, here's a phrase I never thought I would say: bear markets don't last forever. Uh, yeah, that's great. We don't want them to last forever. If they do, we have a real problem. But you have to remember that the moves you make during bear markets can have benefits for decades. It's something that's going to happen. It's not pleasant. It can be painful. We know the emotions that come along with it can be somewhat paralyzing, and we don't know what to do. Let's change that approach next time we get into a bear market. Let's figure out what opportunities this is providing for us so that we can essentially do well in all market environments. If you're not sure what strategies fit your situation, that's what we're here for. We love to build plans that are tailored to your numbers, your goals, and your tax picture.
Yeah, absolutely. And I honestly can't remember if we gave our standard disclosure, but folks, remember, we're not giving you tax, legal, or financial advice on this episode today. We never do, and we always recommend seeking out the help of an expert in those various fields of expertise. But if you have questions, give us a call. And we just want to say thank you for joining us today. If you want to explore any of these strategies for your own retirement plan, reach out to us for a confidential strategy call. You can find us online at crownadvisorgroup.com. That's crown advisor with an OR group.com, where you can click the complimentary assessment button and answer a few questions and schedule some time for an opportunity to have your situation analyzed for potential future opportunities. Or on any of the major podcast platforms, you can follow us and find us, as well as on YouTube as well. So until next time, stay proactive, stay tax smart, and retire stronger. Bill, you want to add anything before we close it out
Only
today?
thing is, we love hearing feedback from our listeners. We appreciate that. If you have any ideas for future show topics or things you'd like to hear us discuss, email us at info@crownadvisorgroup.com. We'd love to take your feedback. Thank everyone for listening this week. John, I appreciate your time being here. For John Foard, I'm merely Bill Kearney. Thanks for listening, and we'll talk to you next week.
Thanks, everybody.